Right. So a good
Hi.
evening to everyone. Thank you for joining the call between MeDirect and BlackRock. Today's theme is natural resources, and with us we have Alexander Foster, product strategist and vice president at BlackRock to discuss this. But first and foremost, we have Ingrid Mikalev of the MeDirect team. Good evening, Ingrid.
Hi, good evening, everyone. And first of all, I would like to, on behalf of MeDirect, thank everyone for joining this webinar. It is actually the 13th webinar in the MeDirect Talk series. And as Matthew already alluded, this time round we are going to be discussing very topical subjects. As everyone is aware, during these sessions, we do feature several financial experts and asset managers, and they all share their views on market and investment opportunities. We have always been here to provide the latest and assist our viewers and clients. Just a reminder that our advisors are also always available to assist you. The representatives we have today for this MeDirect talk are from BlackRock, a multinational investment management corporation based in New York and founded in 1988. So, discussing the current geopolitical tensions that we as investors are currently facing, we have Matthew Kilroy. And obviously, together today, we will be discussing the implications of the ongoing Russia Ukraine war and the latest developments that could happen in regards to the global economies and markets. Following these updates, we will then move on to discuss the commodity and natural resources together with Alex Foster. Historically, commodities and natural resources equities have always performed strongly in absolute terms relative to the broader equity markets, especially during the periods of rising inflation expectations. Alex Foster, Vice President and Product Strategist, is responsible for covering BlackRock's thematics equity fund range as well as its active natural resources and equity products. The primary areas of coverage covered by Alex include the sustainable energy, future of transport, mining, and gold strategies. So, Matthew, starting from your end, can you please give us an update?
With much pleasure. So indeed, we're living history. Since the 24th of February, we saw the Russian invasion of a democratic country, and that's really changed the geopolitics of it, which is what the aim of this sort of first part of the webinar is explained. So we've all heard the current situation, what's happened, but obviously the impact of this it will be reverberated for the decades to come, because we're seeing a dramatic shift in the world order and the relative peace that at least Western Europe has lived for the past 30 years since winning the Cold War. We've had this expansion, of course, of the protection of NATO, and by which we've had since 1999 and 2004 and 2007 countries that were part of the Warsaw Pact joining the alliance after their democratically elected government asked to do so in order precisely to protect themselves from potential Russian aggression. Worth noting that in 1994, Ukraine had signed a treaty with Russia itself, America and Great Britain, in order to give up what was the third largest nuclear weapons arsenal, precisely to protect itself against any future aggression. Ukraine signed with Russia a pact protecting its territorial integrity. Fast forward 26 years later, we've had Ukrainian territory completely violated, not to mention in 2014 Russia's annexation of Crimea. This has had a huge impact for Europe, especially the latest invasion. We have seen a dramatic push towards defense spending. That was a long time US request. Now we're seeing a number of countries at least spending 2% as NATO requires its members to do. But the most dramatic U-turn has been Germany, long time a cozy partner to Russia's business ventures. We can remember the ex-Chancellor Schröder of the SPD party joining Gazprom's board of directors and being one of the main sponsors of the Nord Stream pipeline, which has been suspended at present. May I add, obviously, in this case, Germany has, through indeed the newly elected Olaf Scholz, proposed a spending of $100 billion in defense. And finally, it's meeting its economic strength with hard power, which tends to work best in case of wars, at least as a deterrent. So what was happening is, on the ground, a detachment of Russia from the financial markets, from politics in general, and the world system. It's now become a pariah state. Very few companies are willing to invest in Russia. That was the case already starting in 2022, but it's definitely the case going forwards. And this has had a severe impact on the ruble, of course, 30% drop. We've heard about this. The Moscow Stock Exchange still closed since the 28th of February. That has a real impact for ordinary Russians. Of course, the sanctions are working, and it's the first time in history that such a large player in global markets has been affected by such devastating sanctions. So we're seeing this on the ground, a Russian advance stalling at present. We don't yet know what the future holds. There are, as we can see, as we've seen, some discussions ongoing between the two governments to understand what peace can look like. We cannot, at present, guess what this is, but what we're seeing is a reaction from Europe, perhaps a surprising one. But what's crucial, and if we look towards the future, is that Europe will dramatically disinvest or disalign itself from Russia. It will eventually bring close to zero its imports of gas and oil, but most importantly, it will focus on sustainability, on renewable energy, which it's to be fair, will not be overnight. It will not happen in a year or 2 years' time, but the transition towards net zero, the transition towards sustainability is crucial in this aspect. And for this, we have to remember a number of aspects, because if Europe is aiming to achieve greater energy security as the Ukraine war carries on, and we're seeing what is a supply shock, we believe this will have an impact, of course, on inflation. We saw this happening right at the beginning of the year, where we had inflation slowly peaking up as pent-up demand of 2 years of COVID was beginning to have its effect, of course, on the inflation and CPI and all the other numbers. For example, the consumer price index, for example, just to give you one, we have seen this dramatic spike in this, of course, what is a supply shock, because we are seeing energy and gas prices truly increase in a matter that was very difficult to imagine in a normal, can I say, world. So this will have an impact. What remains to be seen is how central banks will react. So last Thursday, the Fed, the Federal Reserve, so the central bank of the United States, has increased by 25 basis points its interest rates. The markets are pricing a reduction of the original 9 hikes during the course of the next few months to 7. So this is something to keep in mind, because we're looking at a world where the buzzword stagflation appears to come out. Stagflation being, of course, stagnation, so a contraction of the economy, and also inflation, an increase in the overall prices of goods. As such, we're really seeing this kind of theme being understood both by central banks, because we do not yet know when it will peak. It was news of today, this morning, on Bloomberg, that it could peak, according to some analysts, around April, around 8% in America. Remains to be seen. What we are seeing, however, is that perhaps in America there will be lesser speed in the transition towards sustainability. Lesser speed doesn't mean a reversal of that. It will carry on as always, but we'll have perhaps focus tactically in the US oil and gas. As such, we believe that currently, not just for tactical reasons, but also for diversification benefits, looking at natural resources can be a source of returns, can be a source, of course, of diversification, but also we are seeing that energy is one of the few sectors that is performing very well since the beginning of the year. As such, today, as mentioned, we have Alexander Foster of a natural resources team who will be able to give us an oversight on what's happening in the natural resources world, potential impact, of course, of the Russian-Ukrainian war, but most importantly, why in the long term, looking at this aspect within our asset allocation can be indeed a source of returns. So without much further ado, I leave the floor to Alex, and I thank you for your attention.
Thanks a lot for that, Matthew. Just a reminder also to all our viewers that they can submit already their questions if they have any on the site per se. So, Alex, over to you to discuss the interesting subjects of commodities and natural resources.
Perfect, thank you. And good evening, everyone, and thank you for dialing in. Thank you also to Ingrid and the rest of the team from MeDirect for setting this up. As mentioned, my name is Alex Foster and I work as a strategist covering natural resources for BlackRock. Today, I'm going to be giving an update on commodities and natural resources equities. And so by that, I mean shares in companies that produce commodities. And I plan to cover three things really over the next 25 minutes. So one, I wanted to talk about why investors might want to get exposure to commodities, and then why investors might want to get that commodity exposure through investing in natural resources companies that produce the commodities. The second thing I wanted to do is expand more on what Matthew talked about in terms of Russia, Ukraine, and how that has been impacting commodity markets and what's really been driving commodity prices over the last few weeks and months. And then thirdly, I wanted to talk about our outlook for the rest of 2022 and beyond. So what we think we're going to see from here. And as Ingrid said, there's also an opportunity to ask questions, so please do send those in and I'll be happy to address those. So first on slide 5, why might investors want exposure to commodities? And there's really three key reasons. The first is inflation protection. So unlike equities and bonds, commodities tend to be positively correlated with inflation expectations. And there's a bit of a chicken and egg scenario here in terms of higher commodity prices feeding into higher inflation. But I think the important point is at the moment we're seeing both rising commodity prices and rising inflation expectations. And inflation hasn't really been something that investors have needed to worry about for quite some time. But we think commodities are an effective way to hedge against inflation. The second reason investors look to commodities is for diversification in broader portfolios. And commodities have historically been good diversifiers because they're driven by their own supply and demand fundamentals and not just the strength of the economic cycle. There's also certain commodities that have safe haven benefits. So gold is the most well-known example in terms of acting as a safe haven as investors look to it in times of financial market weakness, equity market weakness. You tend to see investors rushing to gold, and so it tends to be a good diversifier in those kind of environments. And the third reason people look to commodities is for returns potential. And with most commodities, they tend to be quite cyclical in nature. So you tend to have up cycles and down cycles. And during up cycles, commodities can offer very good returns, as well as natural resources equities providing outperformance on top of commodity prices. So if we move on to the next slide, we can talk more about natural resources and This is what my team at BlackRock invest in. We invest in the companies producing the commodities rather than the commodities themselves. And reasons to get exposure to commodities through these stocks. First is potential beta to underlying commodity prices. So if you look back through history, shares in companies producing commodities have typically outperformed underlying commodity prices over the long run. So if you looked at returns for the copper price versus an equity index of copper producers, you typically see that over the longer term, the companies significantly outperform. The second point is that if we can find the right companies, they are able to add value above and beyond underlying commodity prices. So if we can find, say, a gold producer that is able to grow its production well, or has significant exploration success, then these companies can perform well, even if the price of the commodity that they produce stays the same between, say, now and the end of the year. And the final point people look to natural resource equities over commodities is because you can avoid a potential negative roll yield, which is associated with commodity futures. It occurs when commodity futures curves are in contango, so meaning that the price of that commodity is expected to be higher in the future, and that roll yield effect can seriously weaken the returns that you achieve when investing in commodity futures. And natural resources equities is a way to are a way to avoid that cost. If we next move on to the next slide and the second part of the presentation in terms of what's been driving markets and what Russia-Ukraine means for commodity markets. So the chart on the slide shows Russia's contribution to a range of commodity markets in terms of percentage of global production. And this is for the year 2021. And what you can see is there's a large number of commodities for which Russia is a very significant producer. The environment we have today of sanctions going on Russia is putting huge question marks around this future supply and is causing significant volatility in commodity prices. And it's not just Russia's production that we need to look to, it's also Ukraine's. So if you look at wheat, for example, Russia typically has accounted for around 17% of global wheat exports, but then Ukraine has accounted for 12%. So in total, around 30% of global wheat exports previously were coming from Russia and Ukraine. There's obviously significant doubt around that continuing at the same rate. In corn, for example, Russia is a fairly small producer compared to other countries, accounting for around 2% of the world's corn exports, but Ukraine is around 17%, has accounted for around 17% of corn exports. So I think, as well as an energy crisis, which is being talked about very heavily in the news, I think we're going to see a lot more talk about a food crisis as we see rising food prices around the world. All of this feeds into what we're seeing in terms of rising inflation expectations. And we don't think of commodities and natural resources equities as a way to, say, benefit from the current environment, but we do think that it provides good diversification as part of broader portfolios to include an allocation to commodities and natural resources equities. If we move on to the next slide, please. I've just included here some charts for commodity prices. What you can see is oil in the top left, then we've got gold, copper, aluminium, corn, and soybeans. And what you see in all of the charts is a strong spike upwards in the last few weeks. Now, I would make the point here that many of these commodities were starting to do very well even before Russia-Ukraine. So Brent oil, for example, rose significantly over 2021, and that was even before, over the full year 2021, and that was before Russia Ukraine really emerged as a big thing. So we saw supportive supply and demand drivers in many of these commodities, and these have really just been exacerbated by Russia Ukraine. If you looked at the equity sector's performance in 2021, the energy sector was the best performing sector last year. So I would say the strength we're seeing in commodity prices and natural resources equities has been exacerbated by Russia Ukraine, but we saw many of these trends happening well before the war started. What we saw in oil, for example, is we were seeing oil supply was being curtailed at a faster rate than oil demand was being eroded. So the focus on the low carbon transition means energy companies are under pressure to reduce their oil production, and many of them have announced that, say, 2019, for example, was their peak production year, and we are seeing less money being spent on investment in new supply of oil. And what this means is that oil supply has fallen faster than oil demand, and so you've seen higher prices, and that has then been exacerbated by Russia, Ukraine. If we go on to the next slide, please. Here we look at energy prices. I'm based in the UK, here in London. We face significantly higher energy bills from the 1st of April. This will be consistent across Europe. We've seen that Europe's dependence on Russia for energy has been highlighted very strongly. In 2021, around 40% of the natural gas consumed in Europe came from Russia. That's why we have seen as you can see in the top right, European natural gas prices spiking significantly above US natural gas prices. And energy costs is a key input into the inflation equation. And so if you go to the next slide, please. Here we show inflation expectations. And what you see really since the start of the COVID pandemic, in March 2020, you've seen inflation expectations rise significantly. So this is looking at expected inflation over the next 5-year period. And in the US, for example, that's risen from around 1% to around 2.3% today. Now, part of this has been driven by Russia, Ukraine, but you can see that inflation expectations were on the rise anyway, well before Russia launched the invasion. What we've seen is that COVID has disrupted supply chains, made the world less connected, and so you are seeing rising prices. You also have some pent-up consumer demand, where consumers were spending less during lockdowns and are now wanting to exercise that demand. That's also been feeding into inflation. And you also have central banks very unwilling to really slam the brakes on monetary policy and raise interest rates quickly. And they've become more tolerant of inflation targets. And so that's why we've seen rising inflation. And our BlackRock Investment Institute, BII, which is our thought leadership division, their view is that we're going to see structurally higher inflation over the next few years. And our analysis on the natural resources team that when we've looked at commodities and natural resources equities is that they have historically been very good ways to play rising inflation expectations. If we move to the next slide, please. Here we look at the outlook for global economic growth. Obviously, stronger global economic growth is typically very good for commodity demand and commodity prices. What we've seen is that the data for the US and Eurozone has been strong for now, albeit moderating. The data for China has been less strong, albeit it has just moved positive again, as you can see from the green line. The thing people are talking about at the moment a lot is the impact of higher energy prices on global economic growth. Higher oil prices tend to be negative for global economic growth, and where it is most of a risk is in Europe. Europe looks most vulnerable to higher energy prices derailing global economic growth. And now a recession in Europe looks a much more likely possibility than it did several months ago. Now, if we move on to the next slide, one of the things the Russia-Ukraine crisis has done is highlighted Europe's dependence on Russia for natural gas and really exacerbated the need for us to invest more in renewable energy capacity. Now, clearly, we had climate change as a massive issue before Russia-Ukraine, and now it's even more important. For us on the commodities and natural resources team, we think that this represents a huge opportunity in terms of structural demand growth for a range of commodities as part of the low carbon transition. So we can't, for example, have wind turbines, solar panels, or electric vehicles without the natural resources sector, without these companies providing materials like copper, steel, lithium to be able to make these technologies. And what's exciting for us is that this low carbon transition represents a multi-decade structural growth opportunity for commodities. We haven't had a really strong commodity demand growth story really since China's economic boom through the early 2000s, from around 2001 to around 2011, where we saw the commodity super cycle. Now, we're not expecting a commodity super cycle on the same extent, but we are expecting many years of structural demand growth. And at this time, natural resources companies are focused on capital discipline. So they're focused on not spending too much, keeping costs low, and returning capital to shareholders. So we think we have structural demand growth, and we have limited new supply coming online. And so regardless of the Russia-Ukraine situation, we see higher for longer commodity prices, and that improving the earnings and profits of the companies that we're investing in. And if we move to the next slide, this is the final slide from me before I'm very happy to open up into questions. The valuation of the natural resources sector to us looks attractive on a number of valuation multiples. So the chart I've got on the slide here shows PE ratios for different GIC sectors within the equity market and looks at the current PE ratio versus the 10-year average. And today there's only two sectors that are trading below their 10-year averages, and that is materials and energy, the two natural resources related sectors. So some people are looking at the outperformance of, say, the energy sector and materials sector so far this year, and are asking the question of, have they missed the opportunity? This chart tells us that there is more room to run on this story. So I'd like to just summarize some of the points I've talked about. One, commodities. The reason investors look to commodities, the key reasons are one, for inflation protection, two, diversification, because it's supply and demand fundamentals that drive them, not just the strength of the economic cycle, and three, returns potential. With cyclical commodities, you can achieve very good returns during the up cycles for commodities. Then the second point was around the reason investors might look to natural resources equities over commodities, and that is one, you can avoid the negative roll yield which is associated with commodity futures. Two, natural resources companies tend to outperform underlying commodity prices over the long term, so you can have beta to moves in commodity prices. So gold equities, for example, their typical beta to the gold price is around 2. So if you have, say, a 10% move up in the gold price, you typically see the gold equities move up around 20%. And the final reason for natural resources over commodities is that these companies can add value above and beyond underlying commodity prices. And that's what we spend our time doing, is looking for companies that have stock specific catalysts that can help them outperform even if commodity prices are flat. So companies we think have good strategies in place to grow their production or reduce their costs or achieve exploration success. Then the second part of the presentation was about what's been driving commodity markets. And I think the important point there is that clearly Russia-Ukraine has driven significant volatility in commodity prices. Oil prices today are $120 a barrel. At the start of the year, they were $78 a barrel. But I think the important point I'd like to make there is that there were positive supply and demand trends for these commodities even before the Russia-Ukraine situation started. And really, we think for investors worried about the Russia-Ukraine situation being very prolonged or even deteriorating, getting worse, commodities and resource equities look like a good way to hedge portfolios against that. Then also what's been driving commodities is the rising inflation environment. That looks like it's here to stay for us. The Russia-Ukraine situation is exacerbating it, but you also have issues like supply chain disruptions. You have central banks more tolerant of inflation, and so we think we're in a structurally higher inflation regime for the next few years. And our analysis suggests commodities, resource equities, good way to play that in portfolios. In terms of where we go from here, we see a strong structural demand story for a number of commodities from the low carbon transition, which is even more important today than it was at, say, the end of 2021. Meanwhile, the supply side of commodities in general looks fairly constrained because the companies aren't spending as much as they were a few years ago. Obviously, supply and demand fundamentals vary by commodity, but that's what we're generally seeing for commodities. And then in terms of the price investors are being asked to pay for the equities, we think that the valuations are attractive. Investors are not being asked to overpay for these stocks, and that was the chart I showed on the final slide. Now, I will finish there. I am very happy to take any questions on anything I've discussed, but also I cover the entire commodity space, so happy to talk about other commodities we've not touched on, or the resource equities in more detail.
Thanks a lot, Alex. And that was very, very interesting. And in fact, we already have some questions coming in. So the first question to kick off a bit this session. So you clearly explained that the issue at this point in time, possibly with resources, is not only on fuels, which probably was getting the most hype from the media, but we are probably facing a very real crisis on the agriculture side. So do you expect these two type of stocks, the ones in investing in fuels and the stocks investing in agriculture, to move the same way at this stage?
Yeah, so we run broad natural resources funds. So we have a fund that say does energy, mining, and agriculture. Our benchmark for that fund is 1/3, 1/3, 1/3, and then we adjust our weightings based on the outlooks. Through 2021, we were overweight energy, and that was the right call as it was the best performing sector last year. This year, we have neutralized our underweight to agriculture, and we've seen many of these stocks performing very well. It's hard to get listed exposure to companies producing commodities like corn and wheat, because much of that is done at the farm level. But where we can get exposure is to companies, say, producing agriculture equipment like tractors. And when crop prices go up, farmer incomes go up, and then you typically see more money being spent on agriculture equipment. It's the time to buy a new tractor when your farmer incomes have gone up. So those agricultural equipment companies tend to give you good exposure to rising commodity prices, rising crop prices. We also invest in fertilizer companies, which give you exposure to rising corn, wheat, soybean prices. And I think if you look at the agriculture sector today, I think it is a good way to hedge broader portfolios against the impact of rising food prices, which I think has been relatively underreported so far versus energy costs. I think we've seen the CEO of one of the companies that we invest in on the agriculture side talking about how it's not a question of if we'll go into a global food crisis, it's more a question of how bad will that global food crisis be.
Perfect. And that ties a bit to another question we received. Do you believe it is rather too late or still in time for investors to actually invest in oil, agriculture, fertilizer stocks now that we have started to see such a rise in stock prices?
So I think if it's a question we've got particularly on the energy side, because you can see that the sector outperformed last year, it's outperformed significantly this year. I think when we look at the valuations, they suggest to us that there is more room to go. And I think people are ignoring for how long the energy sector underperformed broader equity markets. It's really since 2012, with the exception of 2016, the energy sector has significantly lagged broader equity markets. Even 2020, it's significantly underperformed broad equity markets. And so we don't think that the opportunity is over. Where we would be more nervous is investing in spot oil, because that has clearly spiked, particularly in the last few days, and is very dependent on the Russia-Ukraine situation. Were we to see some positive steps in terms of Russia-Ukraine, and were we to see it, the situation significantly improve, you're likely to see oil come off somewhat, because you've seen a bit of a cushion put onto it because of the geopolitics. So where we prefer exposure is in the energy equities, who we think are going to benefit from higher for longer oil prices, and this is going to improve the earnings of these companies, and that to drive outperformance versus broad equity markets.
Thank you very much for that. Another question. Customers tend to normally get attracted more to commodities when they spike in price. Like at this point in time, we are seeing quite a bit of an investors investing in these commodities. Now, obviously, it does expose retail investors to a risk, especially when then we will see a drop again in these commodity prices in the future. Do you agree or not that exposure to commodities should have a limited portion of the client's portfolio, due obviously to the fact that they are deemed to be quite high volatile?
Yes, and I think commodities and resource equities, so shares in companies that produce them, are volatile, and so that should be considered when sizing them in broader portfolios. You have some commodities which tend to be less volatile than others. So gold, for example, tends to be a lot less volatile than, say, the Brent oil price. So you can find some companies which are, or some commodities which are less volatile than others. I think for investors worried that commodity prices have peaked now, and so there's no they've missed the boat. I think look at the valuation of companies producing those commodities. I think also if you think about what would drive commodity prices down is if there was a significant improvement in Russia-Ukraine. If say Putin, and this looks quite unlikely, but if say Putin tomorrow says, right, ceasefire, I'm just going to withdraw back to Russia, then clearly commodity prices are going to fall, given that they've put you've seen a bit of a cushion on top of commodity prices just from this geopolitical risk. But I think in an environment where that happens, the rest of an investor's portfolio is going to do really well in that environment, because that is very good news for global growth, good for stock markets. And that's really what you want from your diversifier, is outperformance when everything else looks pretty weak, and you have to accept your diversifier could or is likely to underperform when everything else does really well.
Thanks for that. Just a quick reminder, if anyone still wants to send questions, we still have a couple of quick minutes. In the meantime, Alex, we have more questions. So at what point do you believe that tech will become cheap again in this environment? We're touching a bit on another thematic here.
Yeah,
If you want, Alex, if you want me to step in, I can answer that question. Tech is a wonderful sector to be looking at the moment, because it's cheap, or it's already improved since the growth to value rotation in the last quarter of 2021. We've seen what were valuations, very high valuations indeed, going down quite dramatically, especially also since the beginning of the year. Tech hasn't been performing strongly. However, since the Russian invasion on 24th of February, we've seen the technology sector perform in relative terms back into positive territory. So despite the sort of the short-term noise, we do believe that technology is a key driver of our portfolio's performance, because we believe quite simply that in 5-10 years time we're going to have more technology, not less. And even today is a great example of technology working, most importantly, but bringing us closer. So as such, we believe that in tomorrow's portfolios, there's going to be more, not less technology. The valuations have improved, and therefore, especially an active fund manager can deliver that selection opportunity in order to look beyond the volatility these days and truly find companies that could potentially perform well in the future.
So sticking to thematics, I'm going to ask another question. One of the other mega trends and mega thematics that we tend to hear quite a bit about is the demographic and social change one. Given the current geopolitical tensions we're currently seeing, do you believe investments in that team will be affected or will have an impact?
Ingrid, perhaps, Alex, I'll just step in, and then if that impacts natural resources, more than happy, because it will probably, especially given that we are seeing indeed demographic change happening in emerging markets. So that's going to be an interesting key driver of growth. Indeed, we believe that demography is one of the mega trends occurring in today's world. As such, there are elements of investment that could be addressed. We're thinking, for example, in the healthcare space. We thankfully are living longer. Given the age, we do have more health issues as such. Private consumption is going up, but equally, there are countries like India and China that have a potential for growth to invest in the healthcare space. So as such, we do believe that demographical change, which also implies urbanization, will have an impact not just in the healthcare space, but also think of the new communities that we can build in a sustainable way in order to make these megalopolies more and more sustainable. But Alex, curious to hear that impact on the natural resource space.
Yeah, so I think the two big things we're seeing in terms of the demographics and social change megatrend is aging populations and urbanization, and those are two trends which we expect to continue. In our thematic funds, we offer some products tied to those two particular themes. So in aging population, investing in healthcare companies, elderly leisure activity companies, this kind of thing. Those two, that mega trend of demographics and social change, we don't see that going anywhere soon, but more relevant for the thematic side, less relevant for the NatRes side.
Perfect, thank you for that. We actually have one last question, and then we will start wrapping up. So obviously we're seeing most, and it was clearly shown also by your charts and presentation, that at this point in time we're mostly affected on the natural resources side, on the Europe side rather than the US side of things. So do you think that US companies tend at this point in time to be a safer haven, especially if we're looking into minerals, agriculture, fertilizers, than the European counterparts?
Yeah, so you're seeing outflows from European funds more than the US. I think for us investing in resource companies, it is often less relevant where a company is listed, because, for example, you may have a company listed in the US, but its assets are located elsewhere. So when we're looking at companies, we have to think about, yeah, where are they listed, but more, where are their assets, where are their sales, and where are their key risks. When we construct portfolios, we think about this. Clearly, it's super important to be on top of political risk. If you say, for example, we're investing in gold companies operating in Russia, they would now be worth close to zero at this current point in time. And so whilst you would have been right about the gold price call, the investing in companies producing gold in Russia are now worth very, very little. So in terms of Europe versus US, I think Clearly, sentiment has deteriorated to Europe in favor of the US. And then for us, specifically on the natural resources side, we tend to spend more time thinking about where the company's assets are rather than where the companies are listed.
Thank you very much for that, Alex, and Matthew. Your information has been impeccable.
Thank you. And hopefully we can start doing client travel again, and we could do a trip to Malta, but that's putting pressure on Matthew.